requested to collect the copy of tax Gurjari from the registration desk after the lunch. Thank you. We come to an end of the formal inauguration of the two-day tax conclave on direct and indirect taxes 2022, organized jointly by All Gujarat Federation of Tax Consultants and Income Tax Bar Association, Ahmedabad, along with the conclave supporters PFC, Real Books, ETTMT, Omkar Rivanta, MP World Travel, Bajaj Allianz, iRecord, HK Computer, and Televiz. We hope all of you will have two most productive days of interesting and stimulating discussions. I sincerely wish that this conclave be a great success, not only as an opportunity to share knowledge and experience, but also as a beginning of long and fruitful friendship among fellow consultants devoted to the most worthwhile task for a better future. We now take a small and important issues under the Income Tax Act 1961 to be delivered by CA Ravikant Kamath sir. We heartily thank sir for accepting our invitation at the last moment and gracing the conclave with his presence in spite of his busy schedule. Can I please request everybody to keep silence? We heartily thank Shri Ravikant Kamath sir for accepting our invitation at the last moment and gracing the conclave with his presence in spite of his busy schedule. Sir, thank you so much for the honor. CA Girish Ahuja sir could not make it to the conclave on account of minor health issues yesterday. We wish him speedy recovery. I request co-chairman of Tax Conclave and past president of AGFTC and ITBA, Praful Shah sir, and CA Vikas Jain, regional council member of ICAI, to escort our eminent speaker, CA Ravikant Kamath sir, onto the dais, along with the dignitaries, CA Shivam Bhau sir, honorary treasurer, AGFTC, Advocate Ratilal Vaghasia, Advocate Anil Shah, Advocate Jignesh Bhagat, CA Rajendra Kabra, CA Ashish Tekwani, Honorary Treasurer, ITBAR. Sir works as associate partner in direct tax knowledge and solutions team of Ernst & Young LLP, having 23 years experience specializing in business tax advisory and people advisory taxation. He also works closely with the tax policy team in assisting the government and industry chambers on direct tax policy issues. Sir has presented his lectures at various seminars and conferences organized by various professional associations and industry chambers. I extend a formal welcome to CA Ravikant Kamath sir, and I request CA Vikas Jain, Regional Council member of ICAI, to welcome sir with a book. Please give them a big round of applause. Thank you, sir. May I now request Advocate Praful Shah, co-chairman of conference, to come forward and welcome CA Ravikant Kamath sir with a memento as a token of gratitude. Thank you, sir. CA Ravikant Kamath, sir, I humbly request you to please come forward and enlighten us. I welcome you, sir.
Everyone, I hope I am audible now. Office bearers of All Gujarat Federation of Tax Consultants and Income Tax Bar Association, Ahmedabad. At the outset, I thank you for inviting me to this wonderful event, the Tax Conclave, for 2 days, which in the morning, as we have learnt or heard all the dignitaries, including Honorable Pannu sir, that this will be journey of learning over the next 2 days. So I am happy that I am the first one to be presenting the first technical session for all of you, which is the core part of this event. And I am presenting to you on the Income Tax Act. 2 days ago, Rupesh Bhai called me up and said that Dr. Girish Ahuja unfortunately has, who was to present this session, unfortunately has tested positive. So, they required somebody else to take up the event. And the subject was recent income tax issues as well as the finance bill. But I said that at this short moment, it's not possible to look into other issues other than the finance bill 2022, because that's the hot topic. And since 1st February, we have always, all of us have been learning about that. So I will be able to deliver only on the finance bill 2022, which he graciously agreed. And that's why I could make it over here. And I thank you for everyone, the dignitaries on the dais, off the dais, for giving me this opportunity to present my thoughts before you. It's good, a physical session after such a long time. It feels very good. Maybe I have taken out even the jacket after 2 years. Otherwise, it was there in the cupboard, hanging, because all the other sessions were happening virtually over the Zoom. So thank you very much. My topic for today will be the key direct tax proposals of Finance Bill 2022. So if you can, I can just request to start the slide presentation. I may not be able to cover all the issues in this budget. Many of them you would have already heard about it. My effort here will be that because this is yet a bill, and technically it is yet to be passed by the parliament, and we could expect some changes even at the enactment stage, which we have seen last 2 years. There have been substantial amendments at the enactment stage. So whatever we discuss today is based on the bill, and with the knowledge that it can undergo some change. So therefore, we try to understand what are the issues, what are the pitfalls, what are the difficulties which one will encounter in these new proposals. And if they are not addressed at the enactment stage, then how do we prepare ourselves to advise our clients, the taxpayers? So with that, let me start. The next slide, please. I have chosen 10 issues for today. And the only thing which will stop you from having lunch is me. So you have to, somebody from the dais will have to give me a countdown that you can wind up your session, because people are feeling hungry for food. So otherwise, we can continue as long as to cover all the 10 issues. Let me start with the first, the virtual digital assets. Before I start, can I just know how many of you have invested in any crypto asset? Bitcoin, Ethereum, or anything? How many of you? Nobody. Okay, that's good. Okay, how many of you that your clients are investing in these crypto assets? How many of you know that your clients are investing? So yes, so there is only one hand. Yeah. So I am starting with a very clean slate. That's an advantage for me. Okay, so you must have read a lot of things about these new crypto assets in the newspapers. And first of all, we need to understand what those products are, how it functions, like that. Is it very similar to shares and securities, which people deal it or not? There are no regulations, there are no laws as of now. The RBI tried to intervene, and they tried to control the banks from the crypto exchanges to function. But there was a litigation, it went up to Supreme Court. Ultimately, it was held that there is no law which prohibits these crypto exchanges from doing business. So therefore, they can continue to do business. So as of today, there is no law which regulates them. There is no regulator, and the government is debating how to, either to ban. RBI is very strongly saying that we need to ban it because it has got so many risks involved. Whereas other people who are investors and other stakeholders are saying this is new technology. This technology is the key. Disruption happens every day. So therefore, it should not be banned. Maybe, to curtail the risk, you can control it. You can regulate it. Now, when that debate is going on, the Revenue Ministry or the Finance Ministry says, what is the easiest thing to do? Now, from a tax policy perspective, you have two choices. First is, under the current law, is it taxable? How is it taxable? You clarify it so that everybody comes to know, whether it is a capital asset, stock in trade, holding period, how do you compute cost, etc., etc. So they could have just come out with a circular, or the tax policy can be used to drive economic behavior. So now this is the second choice which was there before the government, and they have gone by it, by which they say these are risky assets. So let us first come out with a tax regime which you will feel which is very aggressive as such. Why? Because it can also influence the economic behavior. People may not invest in it, or whoever is investing in it, maybe they will be very careful and conscious of the tax consequences. So the tax regime has been brought in. Now, Finance Minister has amply clarified that, this does not mean that the government is legalizing the crypto assets trading. So there is no regulations as of now. But as you all know, as students of tax, that income tax can be levied even on an illegal income. So even if you are earning income illegally, tax can be levied. So there is nothing wrong about levying a tax on the crypto assets. So the new tax regime is divided into 4 buckets, which is there on the slide before you. So first is the definition of virtual digital asset. What we commonly understand as crypto asset is now for tax purposes is known as virtual digital asset. And that's a new definition which has been brought into 247A. Now this provision is effective from 1st April 22, assessment year 22-23. The next piece is the tax rate. So you have new section 115 BBH, which provides for a 30% tax rate on the income from transfer of VDA. And that provision is applicable from assessment year 23-24. So now you will ask the question, definition is coming from assessment year 22-23, tax rate of 30% is coming from 23-24, what is the reason? And the answer is in the next bucket, next piece, which is the TDS provision. Now because all these crypto assets, there is no mechanism in which all the transactions are reported to the government. So they have brought in, here also there was 2 policy choices before the government. Either they tell all the crypto exchanges, file a statement of financial transactions, which is there for many other financial transactions, or they introduce a TDS. So they felt this is an asset which is more riskier, so let us introduce a TDS. So you have a TDS at 1% on payment to a residents. Now the question will ask, why not non-residents? Because non-residents are already covered under section 195 for TDS. So therefore there is no TDS provision, specific TDS provision for non-residents, because the government would have thought that they are already covered by 195. So if there is a taxability in India, then it will be governed by section 195. Now this provision is effective from 1st July 22. So in order to implement this TDS provision, you need the definition of virtual digital asset, and that's why the VDA definition is coming from assessment year 22-23. And the last is, once people know, all taxpayers know that there's a 30% tax rate, so people become very creative. So therefore, as an anti-abuse provision, we have the existing gift tax provision, which is 56 to 10. Most of us would be aware that is being expanded to cover the gift of VDA. So for all these 4 buckets, we'll just understand in a little bit of greater detail. But this is a subject on which you can spend 2 hours, 3 hours. So, I can go on and go on. So my purpose is not, otherwise the entire, session will be consumed by this. So what we will do is we'll understand only the key points, and maybe in your subsequent events, you will have a very dedicated session only for virtual digital asset after the law is enacted. we come to the definition, the first bucket, definition of VDA, virtual digital asset. For the purpose of understanding, you can divide it into three parts, and I have tried to put it in the slide before you. And a clarification, I think the slides will be circulated to all the participants right after the session. So it can be divided into three categories. First category, what I call as a crypto asset. Now this crypto asset is not used in the definition, but just for our understanding, I have, we have coined the name crypto asset for the first, which is a general category. Next is the non-fungible token, and the third is a residual category. Now non-fungible token, non-fungible means something which is not fungible. Fungible means something which is common, each like one 10 rupee note is common to another 10 rupee note. So which is called fungible. Okay, so shares are there in your demat account. Suppose you are holding 100 shares of Reliance. So each share is similar to another, correct? So that is fungible, but this is non-fungible. So this is unique. So these are a very unique kind of an assets. That is, for example, if you look up into the internet, you will see that Amitabh Bachchan has created NFTs for some of his collections, like the Madhushala poems, which he has in his own voice, it has been recorded, and he has created an NFT for that, which is secured by blockchain technology. So what happens is, this is, it's a comparable to, suppose you have an Amitabh Bachchan's autograph, handwritten autograph. Okay, so that becomes your pride of possession. This is an autograph signed by Amitabh Bachchan. Similar thing will happen now in the digital world, where this Madhushala, whoever is holding this NFT, can have the pride of possession. I am holding this collection of poems, Madhushala, which is in the voice of Amitabh Bachchan himself, and this is the only, item or digital asset. No other person will have the similar kind of an asset. So that is the concept of non-fungible token. It's not fungible. Now we come to what is the basic ingredients. How will a particular asset fit into this definition? So if you see the first category, crypto asset, there are three conditions to be fulfilled. All the three conditions are cumulative. But the second condition, there are alternative conditions, one or two. You have to fulfill one of the two. So first is the basic condition, which says any information or code or number or token not being Indian currency or foreign currency generated through cryptographic means or otherwise by whatever name called. So it has to be an information, code, number, token, etc. It will exclude the Indian currency or a foreign currency. And it should be generated through cryptographic means or otherwise. Now this or otherwise is the fault line in the definition, is the area where it's slippery, where there could be a lot of controversies. Now, or otherwise, do you interpret it as expanding the scope of generation, the mode and manner in which it is generated? So it can be, even if it is generated through non-cryptographic means, still it will be covered. Or is it something limiting the definition, that it should be generated through a technology which is similar to cryptography? So whether you interpret it in a expansive manner or whether it is a limitation, is something which will be debatable, and these discussions can go on and on. The second condition, and as I said, these are under the second condition, there are two alternative conditions. One is providing a digital representation of value. So there the thrust is on digital, not physical. So it's a digital asset. So it's a digital representation of value. And the second is it functions as a store of value or unit of account, etc. So either of the conditions has to be fulfilled. Either it should be a digital representation of value or it should be a store of value. So if you take Bitcoin, which is most popular crypto asset. So Bitcoin you cannot see, it's a digital representation of value. Second is you can also transact in Bitcoins. You can buy goods or services by paying in Bitcoins. So it becomes a store of value or a unit of account. So either of the two conditions have to be fulfilled under the second condition. And the third condition is it can be transferred, stored or traded electronically. So here again, the key word is or, it's not and. So it needs to have attribute of either of the three. It can be transferred, stored or traded electronically. Any of the three attributes are satisfied, then the third condition is fulfilled. So all the three conditions are cumulative. The second and the third category. So here in this particular first category, there is a lot of interpretation involved. So you have to see whether this asset fits in or not. All the three conditions are satisfied or not. The second and the third categories are relatively easier because the government has to notify something as a NFT. Then the second limb gets triggered. And once the government notifies something, some digital asset as a NFT, then that NFT as well as any other token of similar nature will also qualify as an NFT under the second limb. So the government has to first notify, let's say they say the Amitabh Bachchan's Madhushala is an NFT by way of a notification. Then the process of interpretation will start. Okay, any other token which is of similar nature to this Madhushala is also an NFT. Now how do you interpret this? Similarity in what terms? All poems, all collections of Harivansh Rai Bachchan, all NFTs of Amitabh Bachchan, or is it the technology, through which has been used to notify this? So this will, give rise to a lot of many issues and debate. Third is, you have just seen that the definition is expansive, yet the government feels that this is a new technology. So therefore it is possible that new assets will come, new crypto assets will come, which may not fit within any of these categories. So therefore they have reserved the right to notify something as a VDA. The last part is exclusion category. The government has also taken the power to notify something as something which will not get covered under the definition of VDA. So it has got both the powers to include something, to exclude something. But here the word is exclusion is with regard to the digital asset. And if you see, the digital asset is not defined. Now the new definition does not define digital asset. And the digital asset term is used in the second and the third category, NFT and the residual category. Let us move ahead. So in this definition, what are some of the issues? Not all, some of the issues which one will face. I think the lot of debate and controversy has arisen on the first point, which is the credit card loyalty points, in-app points, air miles, etc. So whether this will get covered under the first category, which is very broad, information, token, generated through cryptographic means or otherwise, store of value, can be transferred, stored, etc. Whether this will fit in this particular clause or not. If you read literally, one would say, no, it gets covered, but the government's intention was never to cover these kind of assets. These have been since long. In fact, if you go to FBT, CBDT circular of 8 of 2005, in August 2005, they have clearly said this credit card points, etc. are a discount scheme. It's a measure of, giving a discount to your customers. So these were never intended to be covered under the virtual digital assets. So therefore, it is possible to say that this definition, though it may be wide, is not, will not cover these type of, the in-app points, discount points, etc. But it is better that the government clarifies in future. Next, the finance minister announced in her speech that, the RBI will come out with a digital currency of its own. Now, when that is notified, where it will get excluded? Because intention can never be that all the transactions which are in the official digital currency should be taxed at 30%. So possibly it will get excluded either as an Indian currency, or it may be notified, because government has the power to notify to exclude any asset. Third is, suppose this VDAs I am holding for the purpose of lending. Okay, I am not transferring, I am not doing purchase and sale. I have acquired it and I am lent it, and that's also possible. It's an activity which is happening, commercially happening. Just like security shares also you can lend. There is a securities lending and borrowing mechanism. Similar to that, you can lend and borrow these crypto assets. So in that, if I am doing that activity, question will arise whether this VDA is an intangible asset under section 211 or 3212, and whether I can claim depreciation on this asset. So this is also one of the debatable issues. Next is the digital asset itself, as I said, is not defined. The second and the third limb talks about digital asset, but it's not defined. So what it will, the exclusion is also with regard to digital asset. So, if we read very clinically, very technically, the power to the government to exclude anything from the definition is only with regard to the second and the third category, not the first category, if we read very literally. Okay, but perhaps that may not be the intention, and we may see some amendment or a clarification in that regard. The last is, there is no amendment to the definition of capital asset. This has prompted certain professionals to argue that VDA is not a capital asset. But I would personally believe that the definition of capital asset is very wide under section 214. It includes property of every kind, and only certain specific exceptions are there, like stock in trade, personal effects, etc. Otherwise, the existing definition of capital asset is very wide to cover even the VDAs. There is no definition of stock in trade. So therefore, whether you are holding VDAs as capital asset or as stock in trade, both, they are covered. It's not, we cannot say that they are out of the scope of the income tax charging provision. Next slide. The second bucket, definition part we have done. The second bucket is about the rate of tax, 30% on, it is applicable on the transfer of VDA. So it's not applicable on, any other income earning, activity. It's only when you are having a VDA and you are transferring it. That time this, if you make any gain, there will be a 30% tax. The word transfer is not defined in this new section 115 BBH. But transfer, we know, all of us know, is already defined in section 247. But that definition applies only to capital asset. Whereas VDAs can be both. It can be capital asset as well as stock in trade. So therefore, the question will arise that if I am holding VDAs as stock in trade and I am, when will I call it a transfer and when will this 30% tax apply for a VDA held as a stock in trade? There perhaps the answer would be, or at least my personal view would be, their transfer you have to understand in a normal commercial parlance. Even if it is not defined, it is possible to give meaning in a normal commercial way. When do you call, you have, holding certain goods and you are sold certain goods. So when that act of sale results in a transfer. But the act of leasing or, that may not amount to a transfer because the asset will come back. So it is possible to take a view that the sale of VDAs will, fit within the scope of 115 BBH, but leasing may not fit within 115 BBH. Now the tax rate is 30%. In the budget, the surcharge on the long-term capital asset has been reduced to 15% for all types of long-term capital assets. But this is an exception. VDA, if you are holding as a capital asset, if you are transferring it, the tax rate is 30%, whether it is short-term, whether it is long-term, and the surcharge can go as high up to 37%. So the effective tax could be 42.74%. Now this provision 115 BBH not only provides for the rate of tax, it also deals about the computation. So you have two provisions in there which talk about how the income is to be computed, and they are negative conditions. The first says that no deduction in respect of any expenditure other than cost of acquisition or allowance or set off of any loss under any provision in computing the income from transfer of VDA will be allowed, notwithstanding anything contained in any other provision. So this will override the normal rules of computation, and even if section 37 grants you deduction, this section 115 BBH will withdraw it and you will not get the deduction. The only deduction which can be claimed is the cost of acquisition. The second is set off of loss. So therefore, no set off of loss from transfer of VDA shall be allowed against income computed under any other provision, and such loss shall not be allowed to be carried forward to the succeeding years. So no set off of loss is also permitted against this income. So no expenditure deduction except cost of acquisition, and no set off of loss is permitted. Now, cost of acquisition is allowed. So then what is cost of acquisition? So just like transfer, here again the same dilemma is there. The cost of acquisition is defined in the Income Tax Act for capital asset, if you see 55(2), but it's not there for the stock in trade. So for stock in trade, how do you compute cost of acquisition? I think the easiest answer would be that you already have 145A, you already have ICDS 2, which talks about valuation of inventories. It may not be applicable for certain taxpayers like individuals who are not in business, etc. But still, you can adopt this principle. It is a guidance which is given there in the Act. The next issue therein is that just like Demat account, all these VDAs are held in a wallet, electronic wallet. So you may have 10 Bitcoins, right? Now in case of Demat account, there is a specific section 45(2)(a) which says that whenever there is a sale of that, whenever there is a transfer, you apply FIFO method. The oldest item which is there in that particular wallet, that has been sold first. That is a presumption. But over here, there is no such section which is proposed to be inserted. So therefore, the question will arise, how do you do it? Whether you can apply FIFO, LIFO, weighted average, that is also a bit of a debatable thing. Under the present, as the language presently stands, you can adopt any of the method, but you have to then follow it consistently. Next point is it's applicable to both residents as well as non-residents. Now residents, they are liable to global taxation, global incomes are liable to tax, so there is no difficulty. But for non-residents, you require certain specific rules of accrual, citus, etc. So in case of VDAs, unless there are specific rules which say where it is located, okay? till that time, you cannot say whether that non-resident who is earning from VDAs, is that income can be deemed to accrue or arise in India. Okay, so where does this, suppose there is an immobile property which is located in India, if that is sold, you can easily conclude that, income is accrues or arises in India because of section 911. But unless this VDA there is no physical location. It could be located anywhere in the world on some cloud server. So there is no rule which says that this type of VDAs held by residents are located in India, deemed to be located in India, just like you have for indirect transfer. So without those situs rules, it would be very difficult to apply this provision for the non-residents. Second point is for non-residents, they have treaty protection. So, under the treaties are not amended, they take a long time. So therefore, if it is their business income, but they don't have PE in India, then it may not be taxable in India. The next point is about barter transactions. Now, these crypto assets are used for exchange. So one part of the barter is you exchange one crypto asset with another, let's say Bitcoin with Ethereum, okay? And the other part is that it can be used for paying compensation. Like for example, you have employed, let's say crypto exchange has got employees. So salary can be paid in terms of Bitcoins, or professional services can be paid in Bitcoins. So in that case, in both these cases, there is a barter. Now person who is giving the Bitcoin and getting a Bitcoin, now for both, let's say A and B are swapping one Bitcoin with Ethereum, then for both of them, this section will apply because both of them are transferring their assets. It's a swap transaction. In case of the second type of transaction, paying for the services in VDAs, this section will get triggered for the person who is paying. So let's say the crypto exchange is paying salary in terms of Bitcoins. So for the crypto exchange, this section will apply and the crypto exchange will face this 30% taxation. Whereas for the employee, he is receiving salary in Bitcoins. He is not transferring. So therefore, he will be liable to normal taxation, whatever his tax rate is. Then last limb, some issues which may arise. As I said, the second condition is no set-off of loss is permitted, but it is income computed under any other provision. So therefore, the normal question which arises is, if I have gain on VDA and I have loss on VDA in the same year, now that income is computed under the same provision, under 115 BBH, whether it is possible to set it off. Again, a very debatable question. On the literal language, it seems there is an argument possible that you can do it, but after the budget, there have been a lot of discussions, etc., and this issue has also gone to the government. So you can expect some amendment at the enactment stage, whereby this window may also get closed. Next is about the, whether other provisions, like for example, exemption under 54F or chapter deduction is possible or not. It seems to be possible because this provision is, provides for the rate of tax, but after the total income is computed. So while computing the total income, if certain income is getting exempt, then it will not come to the taxation provision at all. The last is about what happens to the losses. This provision is effective from assessment year 23-24. So from any transfer happening on or after 1st of April 22. What about the losses which are already incurred on these crypto assets prior to 1st of April 22? My view would be, it will be governed by the normal provision. You can set it off against your other incomes, subject to the restrictions in the current law, but it may not be possible to set it off against the VDA income. But other incomes, it may be possible to be set off. The third bucket is the TDS. So here TDS is applicable from 1st of July 22, and it is applicable when you are making payment to a resident. The TDS rate is 1%. It's for consideration for transfer of VDA. There is, because it's payment to a resident, the 1% need not be increased by surcharge or cess. And the last part is the section recognizes that there could be swap transactions. So therefore, in-kind transactions, just like you have in lottery winnings. So therefore, what is provided is that the person who is, getting the VDA, who is the buyer, who is getting the VDA, who is responsible for making the payment, he has to ensure, suppose he is also, paying in kind, then he has to ensure that the tax is deducted before releasing the consideration. So for swap transactions, if both of them are liable to do TDS, both of them will have to ensure that the tax is deducted before exchanging the asset, before swapping the assets. Or let's say the second kind of barter that I talked about, if you are making payment of salary in Bitcoins, The employee will have to do TDS, and employee will have to ensure that no tax is deducted before he receives the bitcoins. Some other provisions of 194S, I will not go into much of a detailing, only 2-3 key points. This TDS provision is applicable to all taxpayers, okay, even the who are not in business. So just like today, we have TDS on immovable property. As you say, it's applicable to even individuals, salaried individuals who are not carrying on business. Similarly, this TDS provision will be applicable. They will have to do TDS. However, for small taxpayers, what is called a specified person, there are certain concessions. And there are 3 concessions which are provided. First is that the threshold for TDS is higher. From normal 10,000 rupees, the threshold for small taxpayer is 50,000 rupees. Second is, they don't need to obtain a TAN number. They don't need to file the quarterly TDS return. They have to do TDS, and they may be required to file a Chalan cum statement, which is presently done even for the TDS for immovable property. And the third is, last budget had introduced a higher TDS at a higher rate if the other person, the payee, has not filed the return for 2 years. So that provision will not apply to this TDS, only for the small taxpayers. Now, who is the small taxpayer? The persons who are having sales, turnover gross receipts less than 1 crore, or professional income or receipts less than 50 lakh in the preceding year, or somebody who does not have any income under the business head. So for example, a salaried person, or let's say, an agriculturalist or somebody like that. Here, the issue of guidelines, like 194O, 194Q, etc. Now, this is a new trend which is happening. CBDT is taking the power to issue guidelines. Wherever it anticipates there will be a lot of implementation problems. So on this provision also, the power has been taken to issue the guidelines. The last is the interplay with other TDS. Suppose, if it conflicts with other TDS provision, then what will override? So what is provided is, if tax is deducted under this new section 194S1, then it will override any other TDS provision. So take an example. Now VDAs, you may consider it as a goods, okay? For goods, if you are doing buying and selling, which is the TDS provision which applies, 194Q. So suppose you are buying VDAs and you fulfill that threshold of the 10 crore in the preceding year and value of transaction is more than 50 lakh, then you are supposed to do TDS under 194Q. However, this provision now says that 194S will override. So we'll have to do TDS under 194S at 1% instead of 194Q at 0.1%. The term used is if tax is deducted. So this you can compare and distinguish with other TDS or 194Q or 206C1H. 206C1H talks about TCS on sales, okay, which was brought 2 years back. Now there the provision is, if TCS is exempted, if tax is liable to be deducted and has been deducted. Okay, there should be a liability to deduct and has been deducted. But over here, if you see the language, it says if tax is deducted. So if tax is deducted under 194S, other TDS or TCS provisions will not apply. The last bit is the most interesting part. If there is a conflict between 194O, which is the e-commerce TDS, right? That was also introduced 2 years back, and 194S. Now, this is the new VDA TDS, which will prevail. What is provided is 194S will prevail. But here there is a difficulty, which we will just see in a bit. So e-commerce TDS under 194, who is supposed to do? The e-commerce platform, e-commerce operator, because there are 3 parties there. E-commerce platform, buyer and seller. So, the e-commerce operator is supposed to do the TDS on the income of the seller. Whereas in this particular VDA TDS, this TDS is to be done by the person who is receiving the VDA, okay, who is making payment for that particular VDA. What are some of the issues which we will face in this TDS provision? First is, these are crypto exchanges. Just like stock exchanges, it is very difficult to identify, have a one-to-one correlationship between buyer and the seller. For TDS on goods or TCS on goods, the CBDT has specifically exempted through circular. The stock exchange recognized stock exchange transactions, because there is a difficulty of establishing one-to-one correlation, that TDS or TCS will not apply. But here we will have to wait and watch whether through the issue of guidelines, the CBDT will say that it will not apply. But the problem here is, if you say that it will not apply to the recognized stock exchanges, then a lot of transactions, there will be no TDS at all. So perhaps we'll have to wait and watch how the government reacts to this, and specifically considering that they have provided that if there is a conflict between 194S and 194O, 194S will prevail. Difficulties in barter transactions. Now there, unless you have a valuation mechanism, how will you do TDS? So, if you are exchanging one Bitcoin with Ethereum, unless you have a value, what is the value of Bitcoin, what is the value of Ethereum, then you compare, then you will be able to do TDS. Otherwise, it will be very difficult to do TDS for barter transactions. In transactions where, where the consideration is paid in terms of VDS, as I said, both of them may need to do TDS. Like crypto, I just gave the example, the crypto exchange pays salary to the employees in terms of Bitcoins. Okay. So now here, while doing the crypto exchange is paying salary, so it will have to do TDS under 192. There is no exemption for that. Now for crypto exchange, it's a transfer. So crypto exchange will have to pay 30% tax on that. Employee who is receiving that Bitcoins, now he will have to do TDS under 194S if the value is more than 50,000 rupees. Okay. So on the same transaction, both of them will have to do TDS. Next is it can, if there is a default in TDS, if you are having business income or income from other sources, there can be a disallowance under 40A 1A, which is that 30% disallowance. Now that disallowance will apply for computing income which is other than income from transfer, because for computing income from transfer of VDA, it's specifically provided, it's very simple, consideration minus cost of acquisition. No other disallowance, no other expense, no other set off, etc. Now gift, if there is a gift, it is arguable that there should be no TDS because there is no consideration on what amount you will do the TDS. And I also discussed the last point on lending and borrowing of VDS. Now this, just like 115 BBH, this 194S is on transfer of the VDS. So in lending activity there is no transfer. So possibly a view can be taken that in that case this 194S will not apply. But now then the next question will arise is, okay, if 194S does not apply, then what will apply? Now if you are borrowing VDS and you are earning income and you are also paying in terms of VDS, so what is it? Is it interest because it's called cryptocurrency? Is it royalty because it's intangible asset? Or is it rent because if you are using any asset and paying any compensation, it is rent for the physical asset. So what is, under what entry it will fit, whether interest, royalty or rent is something which we'll need to debate and discuss. The last limb is of the gift taxation. Here what is done is, under 56(2)(10), it is applies to receipt of money without consideration or receipt of any specified property without consideration or for inadequate consideration. Now property is a defined term there, specified property, only certain of the assets like immovable property, shares, jewelry, etc. Now to cover VDA within that, VDAs are now also included in the term of property for 56(2)(10). Now the distinction is, for the other specified properties, it has to be a capital asset because that's mentioned, specified property being a capital asset. Whereas for VDAs, there is no requirement to be a capital asset. So even the gift of VDAs as stock in trade is also getting covered under the gift taxation. Next you say, okay, if there is a tax, how will you value it? On what amount you will pay tax? For 56(2)(10), you have Rule 11UA. But Rule 11UA presently does not cover these VDAs. So it may be amended in due course after the bill is enacted. Third is that under the gift taxation, there are certain exclusions. For example, gift from relatives is exempt. Gift on received on marriage is exempt. So same exclusions will also apply to this gift from VDAs. What is the rate of tax? If somebody is transferring, he is liable to 30% tax. But here I am receiving the VDAs. So if I am receiving VDAs, it's a normal tax rate, the slab rate, which will apply. Now, if there is a taxation, if a particular value is taxed, if I receive VDA and it is taxed, whether I will get a cost step up when I sell it. Okay, if I received a gift of VDAs, suppose its value is 1,000 rupees, when I sell it in future, whether the cost will be taken at 1,000 rupees. Now there, the problem is, if it is a capital asset, yes, you have section 49(4), which gives you that cost step up. So which says that value on which 56(2)(10) tax is paid becomes the cost. But for stock in trade, there is no such similar provision. So again, this is one area of difficulty. For non-residents, you have the difficulty of, absence of situs rules. How will you track the gift for, received by the non-residents? If you cannot say that where the VDA, where they have received it, how does it income accrue or arise in India? Yes, the last point I discussed. Okay. So, this is all about the key features of the VDAs. If anybody has any doubts or something, we can just spend a couple of minutes on this before I go over to the regular provisions, our regular bread and butter income computation provisions. Means either whatever I said has just gone bouncer or it is very absolutely clear. So I'll try to, I am optimistic. I believe whatever I have said must be very clear. Of course, there are a lot of issues, we can spend 2 hours on this. So as to not to spend more time, I'll, move over to the next amendment, section 14A. Now, these are all our regular, I think most of you would be aware of the controversies. Now, 14A applies where you receive exempt income, and what it provides is, if you are having exempt income, then any expenditure will not be allowed as a deduction. Now, there is one limb of the there are so many controversies, and this controversy normally, arose because of the dividend income, which was exempt until a year back. One limb of the controversy was, suppose in a particular year you are not receiving, you are holding the shares, but you are not getting dividend income, whether 14A will apply or not. So you had a CBDT circular and a special bench ruling in case of ChemInvest, which took a view that even if you have not earning any dividend income in a particular year, this disallowance will still apply. However, later on, many high courts took the view that if you don't have exempt income, then 14A will not apply. So therefore, predominantly now the judicial position was that if you don't have exempt income, don't have any dividend income in a particular year, 14A disallowance will not apply. There the problem was the ratio of Supreme Court ruling in case of Rajendra Prasad Modi, which is old ruling, where the Supreme Court held that you don't require any income on the credit side to claim a deduction of an expenditure on the debit side. These sections, section 37, section 57, allow you the deduction. There is no requirement that you should be actually earning income. In a particular year, there may be no income, but still the deduction is allowed. Now, if you apply the same logic, then even the disallowance should apply. That would be the logic. If your expenditure is allowable as a deduction, but it is in relation to an exempt income, even if the exempt income is not there, still, the disallowance can apply. That would have been the logic of this Rajendra Prasad Modi ratio. However, this ruling has been distinguished by the Delhi High Court in case of ChemInvest. And therefore, that it became clear that, this ratio will not apply and 14A cannot apply in a year in which exempt income is not received. Now, of course, the government was not happy with this line of decisions. So it's now changing the law. Now 14A is sought to be amended to provide that, this 14A will apply even if there is no income which is exempt income which is accrued, arisen or received in a particular year. Now, this amendment is of course, made with a view to override all the favorable judicial precedents. It is made effective from assessment year 22-23. So even for the current year, it will apply. The current financial year, it will apply. Why? And the difficulty is in the language. If it was to simply said that, the 14A will apply even if there is no income and this provision is effective from assessment year 22-23, then there was, one could have taken a view that this is prospective amendment. But there is a deliberate use of the language saying that shall be deemed always to have applied. Okay. So though the amendment is made from assessment 2022-23, but what is provided, it shall be deemed to have always applied, as if to show that, it is meant to be given a retrospective effect. What is the intention behind that? Why has the government used that language? Government knows that a lot of cases are pending in litigation for the past years. Now, suppose they do the amendment without using this language. All of you are tax professionals, advocates. What you have to just stand up before the court and say, look, now the law is amended from a future year. So therefore, the law was different in the past year, and immediately the case will be resolved in your favor. That would have been the drawback of not using this language. So what has been done is, it is mentioned that it shall be deemed to have always applied. Now the court will have to think and then say that despite use of this language, whether it has got a prospective or a retrospective effect. So it is a one further step or a one further hurdle which is created. It is now for the court to think and then adjudicate whether it has got a retrospective effect or whether it has got a prospective effect. In many cases, it has been held, despite the use of this language, that it has got a prospective effect. And I would personally believe that this is also prospective amendment applicable from assessment year 22-23. This amendment only says that 14A will apply even if you don't have exempt income. It does not amend other parts, 14A, 2, 3, Rule 8D, etc. So wherever you can prove that you can reasonably compute the expenditure, whatever is the expenditure which has relation to the exempt income, then you will be under it will be a factual compass that you can say that I have not incurred any expenditure. Factually, I have not incurred any expenditure. I have no loan or borrowing for making this investment. Then 14A should still not apply. Now, whether this has got any practical relevance, the maximum controversy was for dividend. Now, dividend from last year, it has become taxable in the hands of the shareholder. So therefore, it will not apply to your regular dividend. There is only one limb of dividend which is still exempt, and which is where you have invested in units of REIT or InvIT. And if that REIT or InvIT has invested in shares of an underlying company, which is called SPV, and that SPV, if it has opted for the lower rate of tax under 115BAA, then the dividend income is taxable. But if it has not opted for 115BAA, then the dividend income is exempt in the hands of the unit holder. So for that limited dividend income, which is arising from the REIT or InvIT units, this controversy can still apply. Otherwise, for other sort of exempt income, there are very few now exempt incomes left where this controversy can practically apply. So it will have a larger relevance to the litigation which is pending for the past years. We next come to explanation to 37.1. Now 37.1, all of us are aware, it's a general section which allows deduction for expenditure laid out or expended wholly and exclusively for business purposes. And presently it had two explanations, explanation 1 and 2. One says that if the expenditure is incurred for any purpose which is an offense or which is prohibited by law, is not allowed. And explanation 2 is on CSR expenditure. Now, lot of controversy arose in case of pharma sector, because the pharma sector was giving gifts to the doctors. So the story started from 14 December 2009, because this was unethical practice. The Medical Council of India amended its guidelines and said that doctors cannot accept gifts, hospitality, foreign travel, cash grants from the pharma sector. Okay. Now when this guidelines was amended, then the controversy, CBDT came out with a circular by saying that because it is prohibited for the doctors, the expenditure which is incurred by the pharma companies will be hit by explanation 1 and it is not allowable. And this circular of 5 of 2012 was upheld by the Himachal Pradesh High Court. The validity was upheld. That is the laying down the correct position in law. Thereafter, we had decisions on both the sides. So some decisions took a view in favor of the taxpayer, but there if we see what are the nature of items where the favorable view was taken, it is some low cost gifts, clinical stationery, product logo, etc., etc. There the company, the court took the view, it is bona fide selling expenditure, it's not a gift, because unless you inform the doctors what are the new products in the market, how will the doctors prescribe that to the patients? So some small token things, now for example, even we are giving memento, you are giving memento, some small token gifts for the remembrance, etc. In those cases, the view taken was in positive, positive view was taken by the tribunals or the courts and deduction was allowed. In other cases where there were hard cases, there were very sharp business practices. We had seen they were giving TV, LCD, refrigerator, foreign trips, personal trips, etc. So in those cases, the tribunals did not allow the deduction. So therefore, there were views on both the sides. One limb, when the taxpayer was arguing the matter, one argument was that this expenditure is prohibited for the doctor, but not for the pharma company. So explanation 1, it will apply to the payer, but these guidelines apply only to the doctors, not to the pharma company, and therefore it cannot be disallowed in the hands of the pharma company. This argument was accepted by certain courts, certain tribunals, and the matter then went up to Supreme Court in the case of Apex Lab, and the Supreme Court's decision came after the bill was presented. So Supreme Court decision came on 22nd February 2022, whereas this finance bill was presented on 1st February 2022. And the Supreme Court rejected this argument. And the Supreme Court held that if the payments are prohibited for the doctors, then it is prohibited even for the payers, for the pharma companies, because it is against the public policy. Something which is, even the law envisages, this is for the code of ethics, for the proper conduct of the medical profession, etc. So the law cannot encourage that practice. So therefore it is prohibited by law even for the payers. So the Supreme Court has rejected this argument of the taxpayer. The next limb of controversy on this was whether the law is only Indian law or includes foreign law. And we had a ruling of Hyderabad Tribunal in the case of Mylan Laboratories, where the Indian company had to make a payment because the court held, the EU court held, that it had infringed an anti-competition law in the European Union. So this payment, again the controversy arose whether this is disallowable. The tribunal took the view that it is otherwise falling within the scope of explanation 1. It is prohibited by law, but law is only Indian law, not foreign law, and therefore it cannot be disallowed. So these are the two limbs of controversy. One is the payer versus payee, and the second is the Indian versus foreign law. Now these aspects are now sought to be addressed in the finance bill. And the finance bill gives the detailed explanation for the doctors' payments, etc. Runs into 4 or 5 pages as such. Now you have a new explanation 3, which is applicable from assessment year 22-23, and this is divided into 3 parts. This explanation 3 tries to explain what is within the scope of explanation 1. So what is prohibited by law or what is an offense? It is trying to explain that, and it is divided into 3 limbs. So first limb is just borrowed from the explanation 1, which says key expenditure incurred for any purpose which is an offense or prohibited by law for the time being in force in India or outside India. So it is now clarifying. Violation could be of both Indian as well as foreign law. The second is about the freebies, the benefit or perquisite. So what it says is any benefit or perquisite in whatever form paid to a person, whether or not carrying on a business or exercising a profession, and the acceptance of such benefit or perquisite is in violation of any law or rule or regulation or guideline, as the case may be for the time being in force, governing the conduct of such person. So you have to think from if that particular payment is prohibited for the payee by any law, rule, guideline, just like medical council guidelines for the doctors, then it will not be allowed for the payer. And the third is any expenditure to compound any offense under any law for the time being in force, whether in India or outside India. So for compounding of any offense, if you are incurring any expenditure, it will not be allowed as a deduction. Next slide, please. So what are the expenses which get impacted by this amendment, which are in 3 categories? Something which is in violation of foreign law, which is prohibited for the recipients, though not for the payer. And the third is the compounding fees paid under Indian or foreign law. Now the second limb, benefits or perquisites which are prohibited for the payer. This amendment is from assessment year 22-23, but as we just discussed, Supreme Court held that this is the law even under explanation 1, right? So therefore it will have a retrospective effect. So it is the present amendment is merely codifying what the Supreme Court has already held for a prior assessment year. Now this disallowance for benefit and perquisite, the controversy has arisen in the pharma sector where payments were made to the doctors. But the amendment is not restricted to the pharma sector. It can apply to any other regulated sector. It could be insurance sector. It could be any business sector as such. Next is the payment need not be made only to the persons who are carrying on business or profession. It can apply to a payment to a person who is not doing any business. So for example, gifts in hospital, you have 2 types of doctors, the consulting doctors and the employee doctors. If you give a gift and it is prohibited for both the doctors by MCI guidelines, then both of them, for gifts given to both of them will be disallowed in the hands of the pharma company. Now, so the person who is recipient need not be carrying on any business or profession. Now under this limb, if you compare the first limb, third limb with the second limb, the first and the third limb talk about law. Whereas this benefit and perquisite limb, talks about law, rule or regulation or guideline. So it is not merely restricted to law, and this gives rise to an issue. Is it intentionally put as to expand the scope of the disallowance? So take for example, many companies have got their internal rules of, their employees accepting gifts from their customers or vendors, etc. So whether the internal regulation or rule will also get covered over here, that is another point of controversy which will arise. The next moot point of controversy, which is not addressed over here, is who decides whether there is an infringement or not. Is the assessing officer is the correct person to decide whether there is an infringement of some other law? He can decide upon infringement of the income tax law, but whether he is the proper person to decide on infringement of any other law, like for example insurance law or something liquor industry law, etc., because he is not competent in those laws, and there are regulators under those laws who decide upon whether there has been an infringement, and they also levy penalties, fines, prosecution, etc. Now this particular controversy will remain open, whether the income tax officer on his own, if that regulator has not taken any action, whether the income tax officer himself takes a view, this is in violation of insurance law, and he disallows the expenditure. So this controversy has been touched in two decisions. First is in case of insurance sector, and another is for the surrogate advertising in the liquor industry. And the courts have held that it is not for the AO to say that there is a violation of other law. It is for those other regulators to say there is a violation. Now, because of this third limb, the compounding of offense, one ambiguity which will arise is on out-of-court settlement. And it's very common in foreign jurisdictions, where instead of going for litigation, you just enter into a settlement, you don't admit any guilt on your part, and you settle the matter by paying a compensation. Now, in this case, offense is not established, right? Nobody admits the guilt, and they just say, we are resolving our disputes by paying this compensation. Whether this will be a compounding of offense or not is something which again will give rise to a controversy. Now, because this explanation has been expanded, you already have a reporting obligation under Form 3CD for expenditure covered by explanation 1. So therefore, the reporting obligation will increase. Tax auditors will also now have to think about, of this expanded scope of this explanation, and proper disclosures will have to be made. If the taxpayer believes that his expenditure is not covered by this expanded scope, some proper disclosure note may need to be provided in order to mitigate any penalty. And this amendment increases the corporate governance for the industry, because they have to not only look from the compliance of laws from their perspective, but also from the perspective of the payees. Let me take some water before I go to the next. Now, related to benefit or perquisite, we have a new TDS provision this year. So there, in the current budget, there are two TDS provisions. 194S, we already discussed about it. Now, for these benefits or perquisites for business, we have a new TDS provision, 194R. What is the rationale for this? We already have a section in the Income Tax Act, 28(4), which says value of any benefit or perquisite, whether convertible into money or not, arising from business or exercise of a profession, is business income. This provision is there since long, since 1964. And when it was introduced, the example was given in the circular that, if any rent-free residential accommodation is provided to the lawyer by the, the company or the businessman, then that value of that rent-free residential accommodation is a perquisite in the hands of the lawyer, and it will be taxed under this provision. Now, this provision was there in the law since long, but practically nobody was offering any income under this particular provision. So therefore, the government felt that this particular income is going untaxed, because people are receiving gifts in the course of their business or profession, but nobody is paying tax. So let us bring in, have a TDS provision so that it will get reported. Then that particular information will come in 26 AS or AIS of that particular pay, and they will then pay the taxes on that income. So we have a new TDS under 194R. Next slide, please. There are certain details and specifics. I'll just touch upon some key points. That this applies to payment to residents, only to payment to non-residents, not to non-residents. Rate of TDS is 10%. Again, because it's a domestic TDS provision, no need to increase by surcharge and cess. Now, the problem is that in case of these gifts, what happens is, just to give an example, that a company is having a scheme for its dealers. Let's say there is an automobile company, and it is providing a scheme for its dealers that if you sell, let's say, 100 cars in a month, we will provide you some gold coin or silver coin. Okay. Now, first is the question of valuation. For doing TDS, you should know the value. So how will this particular gold coin or silver coin will be valued? Second is in whose name you will do the TDS, because you may give it to the dealer, but that gold coin may be taken by home by either the director, partner, or some key employee of that particular dealer. So then the payer has to do TDS in whose name? The dealer's name, dealer which is an LLP or a company, or it has to do in the name of the director, partner, etc., to whom the gift is given. And this is one troublesome issue which we will all face. Next is the disallowance of expenditure for TDS default. If this TDS, normally if you do a TDS default, 40A1A says expenditure will not be allowed, or 30% of the expenditure will not be allowed, but it will be allowed if the payee has filed a return and you are able to give that Form 26A CA certificate. Now in this particular case, let us take an example. Same example, automobile company has floated a scheme and it says we will give gold coins if somebody achieves the target. Now when purchasing the gold coins, it is goods, okay, and there it has to do TDS under 194Q. That 0.1% when it is purchasing the gold coins. Next, when it gives the gold coins, suppose they don't do TDS under this new section 194R, whether the company can argue that look, TDS compliance has been done. When I purchased the gold coins, I have done under 194Q. So therefore 40A1A should not apply merely because there is a default under 194R. I would believe it's a very aggressive argument as such, because the intent of that 40A1A was that everybody should do the proper TDS compliance. Here the expenditure is when it is given as a gift or a perquisite to the dealer. So therefore if this TDS 194R TDS is not done, still 40A1A could be applied. But this, when you are backs to the wall and you want some arguments in defense of the taxpayer, perhaps this is one of the argument. Next is what is the date of applicability. There is some confusion because of the difference in the finance bill versus the explanatory memorandum. Explanatory memorandum says it is effective from 1st July 22, whereas in the finance bill it is 1st April 22. But there is a corrigendum to the finance bill which has been corrected, and this says it's effective from 1st of July 22. Next is about these payments in kind. A lot of these payments will be payments in kind, because cash payments you apply the regular TDS, whereas this is benefits or perquisites in kind. Now for that it is provided, just like lottery winnings, that if your payments are in kind, you should ensure, the payer should ensure that a tax is deducted before the benefit or perquisite is released or provided to the payee. So therefore what is the option? Either if he is giving a gold coin, then he will have to first collect the tax from the payee and then give the gold coin. Now you may imagine that somebody is told that you give the amount of TDS, then take the gold coin. He may say, sorry, I don't want it, you keep it to yourself. That can practically happen, because they will say, now this gold coin will appear in my, this gift will appear in my 26 years. You are deducting tax at 10%, balance tax I have to pay from my own pocket. I don't want it, you keep it to yourself. So, but if the company, wants that person to give the gift, wants to reward that person, then what the company has to do? It has to gross it up. So, it has to pay from its own pocket. So, it's 1 lakh rupees is the value of that particular coin. Then the company will have to pay 11,000 as TDS and then give this coin to that particular person. Next slide. What are some of the issues? There are 3 major issues in this, and that is being represented to the government. One is no valuation rule. Now take the same example which was given in the circular. Rent-free accommodation provided to the lawyer. Okay, either in a home or in a hotel as such. For salaried employees, there is a lot of controversy. How do you value this? Up to 2001, it was based on fair rental value of that accommodation. From 2001, the valuation methodology has changed, and now it is percentage of salary. 15% of salary or 7.5% of salary, because it was creating huge administrative problem on valuation of that accommodation. Now when you are bringing in 194R and the same benefit is given, on what value you will deduct the tax. Second is a distinction between the bona fide business expense and a personal benefit. You can very well imagine if some gold coin is given and which he can use it, that person can use it for his personal benefit, it is a benefit, it is a perquisite, it has to be taxed. But there are a lot of cases where it is very difficult to distinguish between it's a bona fide business expense or it's a personal benefit. Now we take the same example, there is a sales conference. The automobile company calls for a sales conference of all its dealers. Just like we have all assembled together, the more than 3/4 of the day will be spent on understanding the new products, business strategy, etc. And maybe in the evening you will have a networking event, some leisure event like that. Now, whether the expenditure incurred on the entire event can be considered as benefit or perquisite in the hands of those dealers, or whether you can say, no, this is bona fide business expenditure, there is no benefit or perquisite at all. Sometimes, you have a scheme where equipment is given free of cost, like a printer is given free of cost, but he is told that cartridges you will have to buy from me. So what is the strategy? That he will buy cartridges from me. It's a business strategy. Now, whether this printer can become a benefit or perquisite, but the object is that it is a sales promotion measure, because I am interested that he takes cartridges from me and I will earn income and I will recover the cost of the printer also from the sale of the cartridges. So in these cases, just like free medical samples, doctors are given free medical samples. Now, what will the doctors do? They have to distribute to the patients. Is there any personal benefit involved for the doctors in this? So like that, there are a number of examples where this controversy will arise, whether or not it's a benefit or a perquisite. The next is this benefit or perquisite. We saw explanation 37.1, it's a second lip, where it will be disallowed. But this TDS will apply even if it is disallowable in the hands of expenditure is disallowable in the hands of the payer. So if you are making doctors payments in violation of MCI guidelines, not only the expenditure will be disallowed, but you also have to do the TDS. The next controversy there is about double taxation. Now take a simple example. A parent company gives an interest-free loan to a subsidiary. Do you call it a perquisite? Because the subsidiary does not have to pay any interest. What would have happened if it was not given interest-free, or the parent had not given interest-free loan? The subsidiary would have gone to the bank, borrowed the loan, incurred the interest expenditure. Then its income, it could have reduced or deducted that interest expenditure. Let's say 9% is the rate of interest. So it could have deducted that 9% interest. Now parent is giving interest free. Okay. So the subsidiary is saving on interest cost. Is it not already paying tax on that? Because this cost does not hit the P&L. So it is already paying its, income is already higher by 9% interest savings. Then again, if you do a TDS and again, if this 9% is added into the hands of the subsidiary, is there not a double taxation of the same income? Take another example. Let's say a motor car is given as a gift, under a scheme. And let's say that motor car is used by that entity for its own business purposes. Now, this is taxed as a gift, right? And there will be a TDS. Whether that recipient can then now say that this is a capital asset, I have paid tax on it, you allow me depreciation on it. There the question will come, what is the actual cost of that particular motor car? Because it was given as a sort of a benefit or a perquisite. There was no cost incurred. So whether depreciation will be granted or not granted, again a controversial issue will arise. The last point for today's discussion would be, in TDS we generally advise our clients to go conservative. You err on the safer side. You don't want litigation, etc. The payee can claim the credit. He will get the credit. It will come in his form 26AS. Whether he wants to offer it the income to tax or not, he will take the decision. Now in this particular case, where there could be a huge controversy, whether it's a benefit or a perquisite, if the company adopts a conservative decision to deduct the tax, but the payee believes it is not a benefit or perquisite. I attended sales conference because you called me. It was for business reasons. Now if you are taxing me, it is not my income. And if the payee wants to now claim that this is not my income, but he wants to claim the TDS credit because tax has been collected from him, will there be a difficulty? Because under section 199 read with rule 37BA rule, it says that unless you have offered the income, you cannot claim the TDS credit. So in absence of income, you cannot claim the TDS credit. So whether this practical challenge could arise, because if the company goes, takes a conservative approach as such. So that's all about the benefit or perquisite. I move to the next issue on 43B. I have got a reminder, only 15 minutes is left. Okay. So now let me talk about 43B debentures. 43B, as everyone is aware, actual payment condition is there. And one of the items which is covered is interest expenditure, and interest which is payable to banks and certain financial institutions. The logic there being, the banks and financial institutions, they don't offer the interest income if it's from an NPA, because they have got specific rule 43D, rule 6E, etc. Whereas the payer, he can claim on accrual basis. So therefore, what will happen is the payer claims deduction will say that it's not received, it's an NPA, so therefore they don't offer the interest. So the loser is the department in this particular case. So therefore, there is an actual payment condition. And in this section, there are 3 explanations which provide that if the outstanding interest is converted into a loan, then it is not considered actual payment because you have just renewed it. You have not actually paid it. Now, the controversy which arose and went up to the Supreme Court in case of Aqua Technologies was that if the interest is not converted into a loan, but if it is converted into debentures, whether this explanation can apply. And the Supreme Court held that these explanations will not apply. The reason being, the liability is not deferred. The liability to pay the interest is extinguished by issue of debentures, and both the payer and the payee have treated as if the interest is paid. Because the payee, which is the ICICI Bank, ICICI in this particular case, had offered that interest income to tax in its own return. So therefore, the Supreme Court said that there is no abuse of 43B, and therefore this cannot be disallowed. Whereas now we have an amendment, department was not happy with this line of reasoning. So we have an amendment, and where these explanations are being amended, but fortunately it is with a prospective effect from assessment year 23-24, not 22-23. So they are respecting the Supreme Court decision. So there is a prospective amendment which says that the interest which is converted into debenture or any other instrument by which the liability to pay is deferred to a future date shall not be deemed to have been actually paid. So therefore, if it is converted into debentures, it will not be allowed as a deduction. Even if the payee has paid tax on that interest income, still this disallowance will apply in the hands of the payer. Now, one issue will arise. If it is converted into shares, equity shares or preference shares, what will happen? In that case, is the liability deferred or the liability extinguished? Because a shareholder is not a creditor. Shareholder cannot file a suit for winding up. It cannot go and ask for dividend, etc. So there, it is possible to argue that if it is converted into shares or equity or preference shares, then possibly this amendment will not apply. But we have to wait till the enactment stage, because even this argument may be sealed if the government feels that no, that is not the intention. Now, though it is it is allowed as there is a disallowance happens, I would take it that there is one positive feature arising from this amendment, and the positive feature is like this. Now, where do you generally encounter this conversion, etc.? Where that company is under financial stress, there are losses, therefore it cannot pay the interest, and therefore there is a debt restructuring which happens. So they are already in losses, and because they cannot pay interest, it is converted into debentures, etc. Earlier, what would have happened, that if interest is converted into debentures, then because of the Supreme Court ruling, it will be allowed as a deduction. Okay, now your losses will increase, and your life of 8 years will start from there. Second is section 79, where there is a change in shareholding of the closely held company by more than 49%, the losses will lapse. Now, because of this amendment, what will happen is that amount interest expenditure will not be allowed as a deduction. So the loss, will not be incurred in this particular year. The loss will get deferred to a future year. So you will get an extended life for those losses. Even if there is a change in shareholding in between, still that 79 will not prevent you from taking benefit of that loss. So this is one positive feature about it. So I have some 10 minutes left. So let me jump to one of the procedural provisions. I think the updated return, that is, I think, the new modality whereby you can cover up some of your defaults. So far we had heard about or known about original return, belated return, revised return. Okay, now there is a new creature called updated return. What is the rationale for this? What the government have felt that they now have a lot of financial information which is already disclosed to the taxpayer in their Form 26 AS or AIS, whatever you call it. But taxpayers tend to make mistakes. Some incomes which are appearing in 26 AS, they are not offering it to tax. Now, the time for filing revised return is very less. In fact, for the TP who are covered by TP provision, there is only 1 month time. Otherwise, it's up to 5 months. If the due date is July, by December you have to file a revised return. So time is very less. So some taxpayers may not notice this, and they will lose the opportunity to file a revised return and pay up their taxes. So therefore, this new section has been brought about, 139(8)(a), which enables the taxpayer to file an updated return. And that return can be filed up to 2 years from the end of the assessment year. So it gives you a timeline beyond the revised return. However, there is an additional cost involved. You have to pay, if there is any incremental income in that return, you have to pay extra tax of 25 to 50%. 25% if you are filing return within the first year, 50% if you are paying, filing the return in the second year. This updated return can be filed even if you have not filed any original return. So if you have missed filing the return, still you can file an updated return. And the government has got the power to remove difficulties, and certain consequential amendments are also made. And one significant amendment is in section 276 CC, which is the prosecution for non-filing of return. So if you have missed to file return, even the revised return, today under the existing law, you can be prosecuted. But if you have now filed an updated return, then you cannot be prosecuted for the failure to file return of income. So let us understand in what circumstances can you file and what cannot be filed. Now the logic or the rationale for this amendment was taxpayers miss out on make some inadvertent errors. So it is to give them an opportunity to rectify those inadvertent error at the paying extra tax. So therefore there is a long list of negatives, disqualifications. In these circumstances, you cannot file an updated return. The list is very long. First is that cost status of a taxpayer. The CBDT can notify these particular classes of taxpayers cannot file an updated return. Presently, it is not known which classes will be notified, but if CBDT comes out with a notification, then those class of taxpayers cannot file an updated return. The second is important. What is the nature of updated return? If the updated return is a loss return, you cannot file it. So you cannot claim any loss in an updated return. If it decreases your tax liability as compared to your original, revised or belated return, then you cannot file an updated return. So it will be one-sided. There should be an additional income, or even if there is no additional income, no additional tax liability, but there should be some additional income which is offered in that return. Third is, if it results in a refund, you cannot file an updated return. Again, one-way traffic. Or it increases the refund as compared to the original, revised or belated return, then also you cannot file an updated return. Then there are certain circumstances qua that particular assessment year. Suppose you have already filed an updated return, then no second chance, only one chance for that particular assessment year. You can file updated return only once. The next is very crucial. If any proceeding for assessment, reassessment, recomputation, revision is either pending or has been completed, then you cannot file an updated return. The logic behind this is if your case is already picked up for scrutiny, then you cannot avoid the penalty, etc. by filing an updated return. That is the logic. But what it says is assessment, reassessment, recomputation. So therefore it creates certain unique situations or gives rise to certain questions for intimations, etc. We'll just discuss in a minute. Third is if the AO already has some information which is collected from other sources and it has been communicated to the taxpayer. So if the taxpayer is already told, look, I have this information under the Benami Act, Money Laundering, Black Money Act, or I have collected information from the foreign jurisdictions, and this is the information. If the taxpayer, it has been presented with that information, then it cannot escape. Then he cannot file updated return to escape the penalty. But if it is not yet given to the taxpayer, then he can file an updated return. Next is if there is a prosecution which is already initiated, and prosecution could be for any default, then updated return cannot be filed. So it is only for bona fide inadvertent errors that this facility can be availed. In search cases, if there is a search for that year and earlier 2 years, updated return cannot be filed. This slide only gives you the additional tax is to be computed. Basically, it's on the incremental tax. If you have already paid certain taxes before the as part of your original return, revised return, on that you don't need to pay additional tax. But because you are offering certain additional income in the updated return, so there will be additional tax liability, there will be an additional interest liability. On that, both of that, you have to pay extra 25% or 50%. Now, on this additional income, issue will arise whether penalty can be levied. There, the argument is no, penalty cannot be levied, because once this updated return is processed under 143(1), now the comparison will be the total income as per updated return and the assessed income. So therefore, if you already offered certain income in the updated return, there will be no underreporting or misreporting, and therefore no penalty can be levied. The main advantages of the the prosecution for non-filing of return will not apply. Now there is a question mark. There is a separate prosecution provision for evasion of tax. Okay, whether whatever incomes have been offered in the updated return, whether the tax department can say that you missed out, you did not offer it, deliberately did not offer it under the original return, and therefore this prosecution can be initiated or not. It requires some clarification from the department. Possibly the intention is not to initiate any prosecution there. There are certain advantages, there are certain disadvantages of updated return. The main advantage is that you save on the interest cost. Next slide, please. Main advantage is that you save on the interest cost. It avoids the exposure to the penalty prosecution. Sometimes, you must have missed out to claim a particular relief. For example, your additional income is, 1 lakh rupees, but you had also missed out to claim a deduction of 60,000 rupees. Okay, so what you can do, you can claim both, because there will be a net increase of 40,000 rupees. So you can also claim that relief which you had missed out in your original return, or you had not filed the return. Then it avoids the inquiry into the additional income, and mainly it avoids the time and the cost of litigation. However, the downside is, because you are offering additional income, there will be a tax. There will also be an interest under 234C, because this will be now your returned income. Interest under 234B will also apply, because you have not paid advance tax. Plus, on top of that, now there is an additional tax of 25 to 50%, which is very, very significant, very material. So therefore, one may think, take a simple example. If there are certain bona fide error which I committed while filing the return, I did not file the updated return, my case is picked up for scrutiny, and that addition is made. It's bona fide, I missed it. What is the consequence there? I have to pay tax, I have to pay interest, fine, interest 234B, etc. Whether a penalty can be levied. Now there I would argue that this was a bona fide error, and if it is accepted, my defense is accepted, then there cannot be a penalty levy. Another option, you have an option if you don't file an appeal against that addition and you pay up the taxes, etc., then you can claim immunity. That is 270 AA. So you can claim immunity from there also. So there you will not have to pay this additional tax, 25% or 50%. So it's a very conscious call which will one need to take. When do you have to file an updated return, and when you will not file an updated return. And I will now come to the last part, the issues on this, illustrative issues. Slide number 26, please. Yeah. One is the Black Money Act. Now it seems the consequential amendment in Black Money Act has been missed out. So what happens is, if you have certain foreign assets and foreign incomes, and you have not disclosed that income in your return, revised return, original return or revised return, and it is discovered later on, then there is a severe consequences under the Black Money Act. However, that Black Money Act is not proposed to be amended to cover up the income which is offered in the updated return. So as the law presently stands, or as per the proposed amendment, if there is a failure to disclose the foreign incomes and you are covering it up in your updated return, still the Black Money Act can still apply. This perhaps is an unintended miss and may be rectified, but otherwise then it will become very stringent. Then certain situations where, let's say, intimation is not received, you have filed a return, intimation is not received. Whether one can say that the recomputation of the income or assessment of the income is pending or completed. Now there we have a Supreme Court ruling in case of auto and metal engineers, which has held that moment you file a return of income, the assessment proceeding is set in motion. So the assessment proceeding is pending. Now if the ratio of this decision is applied, then if you have filed a return and you have not received any intimation, your assessment is technically pending, and therefore you cannot file a updated return. But however, this is a very technical interpretation. The government does not recognize this. When we discussed with CBDT officials, they said, no, that is not, then this entire mechanism will fail. Nobody will be able to file any updated return. So possibly if they do recognize this, and this technical difficulty can be resolved. Next is, if you receive an intimation, but there is no variation, whatever is your returned income has been accepted, whether you can file an updated return. Now there again is revision, assessment, revision, recomputation. as pending or completed. Whether you can say that the recomputation is now completed because you have 143.1, you can recompute the income. You can make certain adjustments. So whether that is completed and therefore you cannot file an updated return. Again, something which is unintended. And the third situation is if you have received an intimation, but it has certain adjustments, certain additions are made. Whether you can file a updated return there, because here now there is an recomputation is already made. So these are the some three situations where there is a technical difficulty, but possibly the government never intended that, and maybe based on our representations etc. there may be some amendment, some clarification to say that even in these cases the updated return may get filed. The last limb is about the prosecution. Now one point on prosecution I would like to touch. We specifically asked this question. Let's say you have initiated the prosecution for some unrelated default, TDS default, whereas I want to file an updated return for some unrelated income which I had missed. Will you allow me or not allow me? There they said, no, the language of the provision is very clear. Once any prosecution is initiated under chapter 22, means prosecution for any reason, then you are not allowed to file an updated return. Now there the issue will arise, suppose you have merely received a show cause, there is no complaint filed with the magistrate, whether you can file an updated return, again a controversial issue, whether the prosecution has been initiated or not. Department would believe that once your show cause notice is issued, it is a process is set in motion and therefore it has been initiated and you cannot file an updated return. However, in some cases it may be arguable that in this case also, suppose you have received only the show cause and there is no complaint, because show cause you can do compounding and you can close it. Then once you have closed it, now the proceedings are completed and therefore you can file an updated return or not. However, there you need to see the 2 years time limit has crossed or not. So I think time has run out by, I'm just on the dot, 5 minutes left for my scheduled time of say 1 o'clock. If you have any particular issues, I will be happy to discuss them. Right. Petrol pump, yeah. Okay. Okay. So, yeah, so your question is connected to the explanation, the amendment for the explanation, because based on what you discussed.
My question is whether RBI Act is applicable in this case.
No, that.
Tax is paid on the sale of fuel, whatever is fact is there.
Yeah.
Whether tax is paid, whether because of the RBI Act, can income tax take their own money which was in the old laws, can they again
Okay, so yeah. So I think it's not related to the only one point which I discussed, whether the income tax authority is the proper authority to say that there has been a violation of some law. Otherwise, the issue which you have raised, sir, is not related to the explanation amendment. Only on the limited point. Now, there I would believe that there are cases which have said that the income tax authority is not the correct authority to say on the violation of the law. But that is a very controversial point. You have to fight it up to the tribunal or the high court level. And it will also depend. For example, in the cases which were there before the tribunal for doctors' payment, there was very clear, even in the Supreme Court ruling in case of Apex Laboratories, what was provided was LCDs, TVs, refrigerators, personal foreign trips, which, which patently it was in violation of the MCI guidelines. So therefore, still MCI may not have taken any action because, there is no such assessment proceeding for the doctors and all where they, they have to file a return to the MCI, and the MCI will act only if some complaints are made. But here it's a, both are hand in hand. Nobody will complain to the MCI. So MCI does not take any action. In such cases, what can the AO assessing officer do is that he can file a report to the MCI, just like in institute also they do it. That they file a complaint to the institute, ki, look, this particular person has not followed the code of conduct, so please take the disciplinary against him. Similar action can be done over here, that the income tax officer can write to the RBI, ki, look, this is the case, you tell us whether this is in violation or not. And suppose the RBI tells, ki, no, this is in violation, then, case is against the taxpayer. Yes, so similar controversy has arisen even in 35(2)(ab) for DSIR. For in-house weighted R&D expenditure, DSIR has to approve the expenditure. So there, DSIR, disallows certain expenditure without giving any reasons. There is no, speaking order ki why they are disallowing particular items, and they have the guidelines ki certain expenses will not be considered as in-house R&D expenditure. There you have certain tribunal rulings which have said that DSIR has to generally see whether it is a genuine or not, bona fide or not. Whether the expenses, etc. are to be allowed or not, that is the act will say. So DSIR cannot disallow the expenditure. It is the income tax authorities who have to decide upon the case.
Sir, regarding this conversion of inflation to revenue,
Yes.
explained it will not be allowed and disallowed.
Yes.
Because it is not paid in real.
Correct.
So this is regarding the borrower point of view. What about lender point of view?
Okay.
Now in their books, debentures are whether it will be treated as income or not.
Okay. So debentures, the borrowers are generally the lenders are generally the banks and the financial institutions. Okay. So generally the banks are now under IGAP. Okay. And they have, banks are under IGAP. NBFCs are presently, the Ind AS is being applied to them, but banks are generally under the IGAP. Now you have RBI guidelines on when you will recognize an interest income on NPAs. And there has been so many judicial precedents which said that if the banks, financial institutions have not recognized a particular income because of the NPA guidelines, then it cannot be taxed. Now in this particular case also, when the lender receives debentures, it will have to take a call, what is the value of that debentures? Is it realizable or not? Suppose it's a loss-making company, okay? And debentures, if they go and sell in the market also, they are not going to realize anything. Nobody will buy those debentures. They may possibly not recognize any interest income at all. But if they recognize the interest income by saying, these debentures have got value and they will recognize the interest income in their books, then under 43D, they are covered by 43D, read with Rule 6EA. If any interest income on NPA is recognized in the books, they have to pay tax on that.
So these both are not linked.
No.
It looks very subjective.
Yes.
What we have accepted.
Yes. So, they had a specific situation in mind. Of course, the context before the Supreme Court was the lender had already paid the tax. So, where was the abuse? Now, this particular argument they have now rejected.
Okay, so we thank you all for your open-ended questions. We thank you, sir, for the insightful talk. We would really thank Sir heartily once again for accepting our invite within less than 24 hours to deliver a lecture which is definitely a difficult one to prepare, and the job has definitely been a commendable one. Thank you so much, sir. CA Girish Ahuja sir could not be a part of the conclave, and hence sir had to grace the occasion. It was because of his health issues, and the doctor had strictly advised him not to travel. So we definitely thank you, sir.
Let me close with one thing. I am come as a substitute. Whether I am a good substitute or poor substitute, it is up to you. The jury is up to you. Thank you so much.
At this instance, we would like to felicitate the committee members for their sheer dedication and zealous efforts at the hands of our eminent speaker, CA Ravikant Kamath, sir. Sir, may I please request you to felicitate Advocate Praful Shah. Advocate Anil Shah. Advocate Jignesh Bhagat. CA Rajendra Kabra. CA Ashish Tekwani. And CA Shivam Bhavsar. So please felicitate Ratilal Vaghasia sir also. Thank you so much, sir. Here we come to the end of the first technical session. I invite the dignitaries on the dais for the group photo session. We request everybody to please be seated for a small online session, which would be followed by lunch.